You hear it everywhere. On the news, in financial reports, maybe even dropped casually in conversations about the economy. The S&P 500. It goes up, it goes down. Headlines are made. But be honest, do you really know what it is? Is it just some random number for Wall Street types? Or is it something more? Something that quietly impacts your world? Today, we're pulling back the curtain on one of the most watched financial indicators on the planet, the Standard Poor's 500, or as we all know it, the S&P 500. Forget dry definition. We're going on a journey to understand not just what it is, but why it holds so much power, and what secrets it might reveal about the health of the economy, and potentially your own investments. So, what is this mysterious S&P 500? Imagine trying to quickly gauge the health of the entire US forest. You can't check every single tree, right? Instead, you might look closely at 500 of the biggest, most significant trees. That's kind of like the S&P 500. It's an index that tracks the stock performance of 500 of the largest publicly traded companies in the United States. Think giants, tech titans, healthcare leaders, consumer staples, financial powerhouses. They're likely in there. But here's where it gets interesting. It's not just a simple list. How does a company even get into this exclusive club? Lean in slightly. There's actually a committee that decides, based on strict criteria like size, liquidity, how easily its stock can be traded, and profitability. It's not automatic. And crucially, the S&P 500 is market capitalization weighted. What does that mean? It means the bigger the company, based on its total stock value, the more influence its stock price movement has on the overall index value. So, a giant leap or fall in a mega company's stock can sway the S&P 500, much more than a similar percentage change in a smaller company within the index. It's not an equal playing field. It reflects the current economic landscape where size matters. Does that structure truly represent the whole market? That's a question worth pondering. Okay, so it tracks big companies, weighted by size. But why should you, sitting at home, care if the S&P 500 index goes up or down? Reason 1, the economic thermometer. It's widely considered a primary benchmark for the overall health of the US stock market, and, by extension, the broader economy. Its movements often reflect investor confidence, corporate earnings, and economic trends. Watching the S&P 500 is like taking the economy's pulse. Reason 2, your investments might be listening. If you have a 401k, an IRA, or other investments, chances are you own S&P 500 index funds or ETFs, exchange-traded funds. These popular investment vehicles aim to mirror the performance of the index. So, the S&P 500's performance directly impacts the value of those specific investments. Suddenly feels more personal, right?